All right, guys, we'll go ahead and get started again. It's my pleasure to introduce Richard Schmalbeck. He is professor of law at Duke University. He's also served as dean of the University of Illinois College of Law and as a visiting professor at the University of Michigan and Northwestern University. His recent work has focused on issues involving nonprofit organizations and the federal estate and gift taxes. He has also served as an advisor to the Russian Federation in connection with its tax reform efforts. The second edition of his federal income tax casebook, co-authored with Seligman, was released by Aspen Publishers in 2007. He graduated from the University of Chicago and later from its law school, where he served as an associate editor of the University of Chicago Law Review. Prior to beginning his teaching career, he practiced tax law in Washington, D.C. Professor Schmalbeck's article for this issue is entitled Gifts and the Income Tax, an Enduring Puzzle. He will explain how the treatment of gifts has changed throughout this nation's history. Thanks.
Thanks, CJ. And thanks generally to LNCP and to Larry for including me in this conference. I must say I'm thankful, but also a little self-conscious because I'm really not a legal historian. I haven't done much history except in the very loose sense that some of my articles include some reference to things that have already happened. So I had a little feeling when I saw the guest list that Larry had invited all of the leading tax historians and me to participate. But I am really interested in this field, I've got to say, if so far mostly as a spectator, and delighted that it's taken off, because one of the frustrations I've felt as a tax person for a long time is that most of the sort of meta-analysts of law, whether it's legal historians or legal theorists or constitutional theorists, whatever, they mostly ignore tax, and I think the reason that they do that is that tax is so complicated. It is so rich would be the good way to put it in detail, but messy would be the way I think that a lot of these meta-analysts would look at it. Just too much to get their hands around, and so it tends to be neglected. And about, I don't know, about 15 years ago or so, some younger tax scholars really began to take this very seriously. And I think it's been a big improvement to the field. It's also true that, I'm sure just by coincidence, that that's about the time that we began to have apparently serious candidates like Steve Forbes running for presidency on a platform that consisted of a single stake, which they planned to drive through the heart of the IRS. So there's also, in addition to being inherently interesting, the field has a kind of interesting safety play aspect to it, because there may not always be an income tax, but there will always be a history of the income tax. Speaking of history, about every decade or so, I'm beginning to see a pattern here. Larry organizes a symposium, and I participated in what I think was his last one about a decade ago, on taking critical tax seriously. And he was fairly critical of a paper in that conference by Moran and Whitford that was entitled A Black Critique of the Internal Revenue Code. And I provided a response paper that mostly supported them, but I was critical of one of the claims that Moran and Whitford had made, which was that Section 102 was a provision. Section 102 is the provision that exempts from income amounts received by inter vivos gift or inheritance. And their claim was that that exclusion biases the income tax, one of several things that they thought had that effect. And it was really the first time I'd had to think hard about that, because it seemed intuitively not quite right to me, and I did include a small section in my response paper on that, but it's only a few pages. It wasn't a prominent feature of their paper, and so it made no sense for it to be a prominent feature of mine. But it sort of lingered in the back of my mind, and when Larry mentioned this symposium coming up, I thought this was maybe the time to explore it in a little bit more detail, and so I jumped at at the opportunity to do that. I've been haunted since then a little bit by the symposium title, The Turning Points in History. I keep looking for something, you know, like the nobles confronting the king at Runnymede and forcing the Magna Carta to come out. I found nothing like that. But there's one big turning point, actually, but unfortunately I haven't been able to find a lot about it. And that's this, that the early versions of our income tax, the one in the Civil War era and then the ill-fated 1894 attempt, did include inter vivos gifts in the tax base, in the income tax base. And then when we came to 1913, the Revenue Act did not, and it would have been very helpful to my paper if Congress had taken the trouble to explain why not at that time, but they did not. Statutory histories tended to be pretty scanty in those days generally, and so there's no discussion of this issue that I've been able to find about why it changed, Congress changed its collective mind. There's one theory, actually theory is too strong because that suggests that there's some evidence pointing in this direction, conjecture that this has something to do with the fact that there were also discussions at the time of an estate and possibly a gift tax. And that may have had something to do with it because at least a few people have considered a gift tax as a substitute for the income taxation of gifts. It's not a very good substitute. They're really quite different taxes structurally. But at least some people do treat them as interchangeable enough that the discussion surrounding wealth transfer taxes might have taken a little of the steam out of the idea of including gifts in income. The estate tax was added in 1916, not long after the first permanent income tax in 1913. So discussion of that was obviously in the air at about the same time. Anyway, I'm going to continue to search right up until LNCP tells me this issue is actually going to press, or whatever things do these days instead of going to press. So any of you who have information that might help me on this, I'd certainly appreciate it. Appreciate hearing about it. There just isn't a lot on this, but let me move more directly into my topic here. I've kind of tried to create, in a way, a sort of congressional debate that doesn't appear to have ever happened, but which might have, having to do a little bit with the sort of paradox of gifts. So what is the paradox of gift? You know, kind of interestingly, certainly when I first started teaching tax, I didn't think of this as at all paradoxical, and I kind of think that most income tax people don't consider this a paradox. So the first step in resolving the paradox is to convince people that there's a paradox there to resolve, and so I'll begin with that step. And the paradox seems to me basically this. A gift under standard understandings of what constitutes income seems like income. And when I say standard understandings of income, I'm referring to the Haig-Simons income definition. Now this was most comprehensively elaborated, I guess I could say, in Henry Simon's 1938 book, Personal Income Taxation, which suggests it's sort of anachronistic, because that is, after all, what, 25 years after the enactment of the tax itself. But it's the Haig-Simons income definition, because a lot of this came from R.M. Haig, who was writing in the early 20s, and a lot of both Haig and Simons' work was influenced significantly by Seligman's work that was in the early 20th century. So even though they weren't elaborated, as I say, in this comprehensive way until 1938, these are basically the ideas that were floating around at the time that we were developing our income tax. So I think if you'd asked people sort of what their general sense of income was even in 1913, it would have been something like this. And every tax teacher and I think probably everybody who's had federal income tax is familiar with this definition that income is consumption plus the change of wealth within an accounting period. And you have to ask, on an individual level, if we're looking at the donee, how can this not be in one of those terms? You receive value from the donor, and you either spend it, in which case it would show up in the consumption term, or you hold on to it as an increment to wealth. It's got to be there one place or the other, or some mix of the two. So when you look at it from the individual donee level, it certainly looks like income. Okay, so that's only half the paradox. The other half of the paradox is that gifts don't seem to be income when we look at it in the aggregate. And I have this kind of fanciful example in the paper that might not survive the next draft, but it consists of the idea of a substantial wealth transfer where every tax teacher in America hands over some sum to the person next in line alphabetically. So we start, I think, with Nancy Abramowitz. I didn't find anybody earlier than that. Move to Ann Alstott, Ellen April, ... until we get to the end. These people are people who can co-author with just about anybody and get listed first. These are the people who have the opposite problem. They can only, poor Larry only has really Eric Zolt and Victor Zanana, I think, as potential co-authors. Oh, Zielinski, I forgot Zielinski. Okay, right. Anyway, you get the idea. You get the idea. So what if everybody in this big circle gave $10,000 or $100,000 to the next person on the list, and then when we get to Victor Zanana, he gives the same sum to Nancy Abramowitz? Have we done something that creates national income, that increases national income? It just doesn't look like it in the aggregate. And I think I decided actually at some point that this example probably wasn't as good as one that I found someplace else. Its only advantage was that I thought of it. But the other version that I ran across was one in the Bittger and Locken treatise, where they ask, what if father inherits 100 from grandfather, gives it to his wife, who uses it to buy a bicycle for their older son, who decides the bike is a little too small for him and so gives it to his younger brother. Do we see $400 of income in that series of events? And the answer is clearly we do not. So when you take it in the aggregate, it just doesn't look like something that creates income. And I think the resolution of the paradox requires a linked donor-donee view, and there are basically four combinations of the treatment of the donor and the donee, and we're going to kind of go counterclockwise through these. One possibility is that the donee would have to include it, but the donor would not get a deduction. So we have a no answer on the donor deduction question, but a yes answer on the donee inclusion question. And alternatively, we could say, yes, the donor does get a deduction, but yes, the donee does have to include it. We could possibly say that the donor gets a deduction and the donee wouldn't have to include it. That seems like it might be kind of a defunct cell in this matrix, but as we'll see, there are instances of it. In fact, each of these cells turn out to be populated. Actually, this one is populated by corpses, so I'm not sure we can count that as populated, but it was once populated. It's the old rule that Congress did not reintroduce to the 1913. And then the fourth one is where we do not allow a donor deduction, but we also do not require donee inclusion. And that's, of course, the rule that essentially we have as to most standard gifts. Now, how does this resolve the paradox? Well, one of the things that we note about option number one is that it has the defect of creating income that isn't there. It's revenue increasing, but not for any very defensible reason. It does create this cycle where the family has $400 of income because the inheritance gets invested in a bicycle, which is passed from hand to hand, and or my circle of gifts among all American tax professors. That's a pretty serious defect, it seems. But it could be defended. If we go back to the Haig-Simons income definition, it could be defended on these grounds. We decided that the donee was going to have a positive change in wealth as a result of the gift. And the other side of that coin is that the donor suffers a decrement to wealth. So a decrement to wealth means that income goes down, and the way you would reflect that in an accounting sense is to allow it as a deduction. But one of the moves that defends the first cell, which probably underlies in some kind of unconscious way the 1894 version of the income tax, and underlies in quite an explicit way Henry Simon's explanation of all this, is that although there may be a decrement to wealth of X, if X is the amount of the gift, it is not unreasonable to view that as consumption activity by the donor. So if we thought that this goes down by X, but this goes up by X, then there's no change. If there's no change in income, then there's no basis for a deduction. So that's basically the explanation of number one. And I go through this in the paper a bit and try to explain that although that's not it's not a crazy idea, but it's probably not as sound as thinking of a gift as a transfer of a consumption opportunity rather than consumption itself. We think of consumption as something in tax terms, at least. I mean, economists have, I suppose, different views of this depending on the context, but I think we think of it primarily as something that consumes resources, consumption in that sense. And so we would distinguish, for example, a transfer, if we're looking at somebody who's not a donor, but somebody who's maybe Bertie Wooster transferring value to Jeeves, his butler. Okay, so that's a decrement to Bertie Wooster's wealth, but it's clear consumption. You know, if you're familiar with these P.G. Wodehouse stories, you know that Jeeves was an unbelievably resourceful guy who could probably have been keeping an investment bank out of trouble rather than keeping Bertie Wooster out of trouble. And so the fact that his labor services are devoted to providing buttling services to Bertie Wooster is an example really where we have kind of two consumption cycles. So it is appropriate to include it in Jeeves' income because it's an accession to his wealth without any offsets, but to not allow Bertie the deduction for the transfer to Jeeves because in that case it is clear that although there's a decrement to wealth to him, it is appropriate to regard that as consumption. So I think if you think about the payment to your butler as opposed to the gratuitous payment to your grandchild, you can sort of see the fundamental difference between a consumption activity and a transfer of a consumption activity. And so that's primarily what makes me think we probably should move on from one to number two. Number two is symmetric, I call it. And what I mean by that is that it's not something that either increases or decreases national income for tax purposes. Because we allow a donor deduction, the amount of the transfer will come out of that person's income accounts, but because we also require donee inclusion, it will show up in another person's accounts. Now, that's, I think, a pretty decent conceptual view. And in fact, I argue in the paper that's really, in many ways, the best conceptual view of what's going on in a gift situation. It really is the one that pays the most attention to the Haig-Simons income definition. Or rather, through most of our income tax history, I guess technically it was not particularly true in 1913, but it certainly became true as early as 1916 when the rates went way up. and has continued to be true, or certainly continued to be true until 1986. We had a very broad spread of rates, with the ascension in the bracket schedule continuing through very large amounts of income. I forget the exact numbers that I have in the paper, but if you looked at as recently as the early 60s, the brackets went up to 91%, and they continued to ascend until you had an income which, in inflation-adjusted dollars, would be over $2 million in today's dollars. Now we have brackets that run from 10 to 35%, and you get to the 35% bracket rather quickly at an income of just $350,000. Just $350,000, of course, is a sizable income, but not so much in this context. When we're talking about wealth transfers, we're mostly talking about people of considerable wealth. And it is now the case that the wealth transfers that go on in any serious way are the ones among members of families where it may well be the case that every adult member of the family is in the 35% bracket, in which case there isn't much of a bracket effect. And I did limit that to adult members. As to minor members of the family, they may not be in the 35% bracket, but another change to the tax, namely the kiddie tax, so-called kiddie tax, that taxes income of minors under some circumstances at the rates that would have applied to their parents, accomplishes the same effect. So a lot of gifts that might take place today among relatively high wealth families, the ones that really are probably the most significant in looking at the aggregate. There isn't so much of a bracket effect. There's hardly any at all. So it might be time to reconsider this if we decide that number 2 really is the better approach to this. Okay, 3. As I said, seems like it would have no defenders. It's going to be a revenue drain if we allow donors to deduct it and don't require donees to include it. Hard to think of why we would ever do that. And the answer of why we would ever do that is box 3 does describe our treatment of charitable gifts. It doesn't describe the intra-family gift, but charitable gifts are in fact in this number 3. And we should kind of protect the boundaries of number 3. I think there is a pretty good justification for allowing deductions for charitable contributions. That's a little beyond the scope of this paper, but I do teach in this area, and it does seem to me that the arguments in favor of allowing that are convincing. And the most convincing to me is actually the one developed most extensively by William Andrews in his 1972 paper on personal deductions in an ideal income tax. And it relates very much to this. It is basically derived from the Haig-Simons income definition. It does say something like, we need to allow a deduction because there has been a consumption opportunity that's been transferred from the charitable donor to a charitable organization, which is really an intermediary for others. And so if we do consider that as a transferred consumption opportunity, we should allow a deduction. Now, that's the same argument we used for number 2. But in number 2, we said, well, we can't really implement that generally because we're just concerned about this bracket effect and about the tendency then of gifts to end up being reported on lower bracket tax returns. That's just too big a revenue loss. Here, there's a revenue loss associated with it, but it's a revenue loss that has a sort of well understood and approved public purpose, namely the advancement of charity. So we actually do take this third box seriously, but only as to charitable donations. And so we have to kind of protect the boundaries of that to make sure that only ones that are advancing appropriate charitable purposes find their way into that box. That brings us to number 4. And I argue in the paper that number 4 is really a kind of surrogate taxation option that is a variant of number 2. It has the same advantage of being symmetric, so that we don't add to aggregate taxable income or subtract from taxable income, but it avoids the bracket effects of number 2. But it's important in thinking about this, it seems to me, to recognize that 4 is sort of a second choice. It's a second best option, at which we do primarily because of the concern in number 2 about transfers of consumption opportunities, if they are treated as a transfer of a consumption opportunity, they end up showing up on low bracket tax returns rather than high bracket tax returns. Okay, so I said I would indicate what the population of these cells were. Well, this is basically the choice that Henry Simons and some of the other early economists were arguing for. It's the choice of the 1894 income tax and the Civil War tax before it, but we haven't seen much of it since. And Congress hasn't really explained why. This one turns out to be sort of this is a place where we maybe could include what I call defective gifts, things that maybe could have been gifts or might not have been. An example being Duberstein's Cadillac, which I think most people are familiar with, but just very quickly, the facts of Duberstein were that a businessman in New York who made a lot of sales, Mohawk Metals was the New York business, made a lot of sales to Duberstein, who was a metal fabricator in Ohio. Duberstein gave some tips to Mohawk Metals about others in Ohio who might be plausible customers for Mohawk Metals. It turned out that was correct. They were customers, bought a lot of stuff from Mohawk Metals, and so Berman, the president of Mohawk Metals, gave Duberstein a Cadillac worth $42.50 at whatever tax year that was, sometime in the mid-1950s, and would have a value today of probably $45,000, $50,000, something like that. So a major gift, but one that was found by the Supreme Court not actually to be a gift. And so it did end up that Mohawk Metals' attempt to deduct it was successful, but Duberstein's attempt to exclude it was not. So it ended up being in this cell after the Supreme Court had decided it. The other option, and one that I talk about a little bit in the paper, but I'm not going to have, let's see, how much time do I have? Not much left, right, if I'm going to leave any time for questions.
15 minutes.
Yeah. Okay. Well, the other option, the other thing that populates this cell are appreciated property gifts, and here's what I mean by that. The basic rule combining the provisions of Section 102 with the provisions of Section 1015 are that if the donor has property, take an example, a property bought at a price of 100 that's now worth 300, if that property is transferred to the donee, there's $200 of built-in income that the Haig-Simons definition would have said could have been taxed as it was accruing to the donor. For practical reasons, we've allowed a deferral of that, but really it is the donor's income. But the donor does get to transfer it. In effect, the donor gets a deduction. And so it is appropriately in the yes box for the donor. It gets a deduction by basically not being taxed on that gain, even though Haig-Simons would have said he should have been taxed all along. But the donee will face inclusion if the asset is sold, and the donee then, because of the rules of the 1015 basis adjustment, the donee has to include that amount. Okay. And the other cells, I've already discussed the charitable contribution treatment, and the fourth cell is our long-standing current rule. Well, the paper traces developments in the case law, legislation, and administrative treatment of gifts over the 96 years or so, but the overall pattern has been to try to make sure that we confine Box 3 to charitable contribution treatment. Box 4 is our default rule, but as I say, I think more as a surrogate than because it actually enjoys a particularly strong conceptual underpinning. And 2 is where we end up with a few kind of oddball situations here and there. Now, I was going to, the paper talks a fair amount about Oberstein and Stanton, and so I was going to too, but I'm kind of running out of time, and I do want to allow a little bit of time for questions, but just kind of very quickly, the Supreme Court decided two cases that were joined because they created an apparent conflict in the circuits. The Oberstein was an Ohio case, so in the Sixth Circuit. Stanton was a case that involved what amounted to a severance payment to an executive of a church, a particularly wealthy church that had a lot of property that Stanton was in charge of managing. And when he left the employ of the church in the 50s, he got a $20,000 payment, again, a payment that would be 8 times or so as large today, so a well into 6-figure payment. And the Second Circuit said that was income to Stanton, but the Sixth Circuit said that Oberstein's Cadillac was not income to him. The cases were sufficiently different that the split in the circuits was mildly spurious. I think you could certainly have reconciled the different outcomes without concluding that the Second and Sixth Circuit had materially different standards that they were applying to the cases. But one of the opinions actually mentions that the government was urging a grant of certiorari to decide these cases so that the government could advance its test. And its test was basically that if there was a business reason for the gift or for the transfer, it could not be a gift. And what they were trying to do really in that was to get it into one of these two cells. Because if it was for a business reason, then there's a good basis for a donor deduction, and therefore we don't want it to be a gift, so we want to make sure the donee includes it. If, on the other hand, it wasn't for a business reason, then we may be okay allowing exclusion on the donee side. So the government was really trying to push for either box 2 or box 4 in all cases. But the Supreme Court didn't buy that. They did not adopt the government's test, and in what is one of, to me, the most hilarious lines in the tax jurisprudence, which may show the shortage of hilarious lines in the tax jurisprudence. But one of the most hilarious lines is Justice Brennan saying, you know, to adopt the government test would be painting on a large canvas with a broad brush. Well, you know, this was the warrant court. They were sort of the Wagner power painters of jurisprudence generally, and Brennan did more than his share of it. So that has to be disingenuous. But they did not adopt the government test. And indeed, if you look at, again, this is in the paper, and I don't have time to talk about it now, but there was a third case that wasn't technically a companion case, but was decided the same day involving payments by a labor union to a non-union member who was participating in a strike called by the labor union. And if you look at the 3 cases together and separate out all of the 10 opinions that were written on these 3 cases, what you find is that there were actually 14 votes out of the 27 in total, 3 cases, 9 justices. There were actually 14 votes in favor of gift status in these 3 situations, none of which seemed to me ones that should have been considered gifts. So they not only didn't adopt the government's test, but they didn't really come to the outcomes that the government might have preferred. But the government did get a little something out of it. The outcome in Oberstein was valuable. It shows that just because a transfer was totally and truly gratuitous doesn't mean that it's going to be an excludable gift. And since then, Congress has stepped in at the urging of the Treasury Department with amendments to the code, including Section 274B, which very much limits the deductibility of so-called business gifts, Section 102C, which says that no transfer from an employer to an employee can be considered a gift. So Congress has taken some steps of a sort that I've described in the paper to assure, again, that the outcomes end up in box 2 or box 4, but not boxes 1 or 3. I had more. I didn't think it would take as long, but let me stop now and leave some time for questions at least.
One way that I think a lot of people think about the choice between box 2 and box 4, I forget which is which, but I bet I'll know in a minute. Is the choice of box 2 rather than box 4 is necessary to protect the integrity of the Lucas v. Earl rule, that income is taxed to the person who earns it rather than the person who consumes it when they're different people?
Yeah, that's the defense of box 4, I think.
Okay,
right?
well, maybe I get
yeah.
yeah. Because you could otherwise do an end run around Lucas v. Earl just by making the deductible and includable gift, so to prevent it. So I guess the question is...
That depends on, I mean, well, go ahead. Go ahead. Sorry. I mean,
Oh.
not everybody regards Lucas v. Earl as a bedrock, and I don't.
But
many people do. Many people do. Let's go ahead.
That's more or less the question. The question is there...
Yeah, okay. As soon as I find the switch, I'll do that.
Well, but it wouldn't make any sense to have Lucas v. Earl and have the deduction inclusion. You have to have consistent with the two. But the question is there in fact any difference between the question of 2 versus 4 and whether...
Okay. Okay.
Do you see any difference between the Lucas v. Earl question and the 2 versus 4 question, or are those exactly the same questions and different?
Yeah, I can understand Lucas v. Earl as a matter of administrative necessity. It's much easier to track down the person who earned it rather than tracing it through to the person who ultimately gets to consume it. But I think if you take the Haig-Simons income definition seriously, you would say we should take account of the subsequent movements of consumption opportunities. And so if the consumption opportunity is initially received by A, but A transfers it to B, then, again, I'd sort of start out with it in the gross income of A, but allow a deduction for the transferred consumption opportunity. It seems to me that's more faithful to the Haig-Simons income definition, and not completely unfaithful to Lucas v. Earl, because it at least has a fidelity to the idea that we initially include it in the gross income of A, but subject to subsequent events, just as we do with any deduction. Any deduction, you could say, encroaches a little bit on Lucas v. Earl, because amounts that you pay for medical care under some circumstances end up ultimately being taxed to the doctor and not to you, and we're okay with that. So if you look at Lucas v. Earl only as imposing a rule on the initial assessment of gross income, but subject to the possibility of deduction, I guess I don't think that my argument for box 2 is terribly at odds with Lucas v. Earl. Steve.
Let me just suggest a few more conjectures for that.
Okay.
I actually think I have in my mind, but not enough of a site to give you. I think there's a Yale Law Journal article from, this general for somewhere between 1916 and 1920.
Are you thinking about Joseph Dodge's?
Not quite that old.
Oh, I'm sorry. What did you? I thought you said 1960 and 1980. What did you say? 16. So, he's still around, and I just misheard the dates. I'm sorry. I did not mean to suggest that he was Methuselah. Okay. And Dodge's was, I think, in the Yale Law Review, too. Yes. So, right.
But the issue, so I think the issue that the article I'm remembering is about constitutional questions. I think that, and again, it might have been even speculation by the author as opposed to some true legislative history, but there were very big concerns about taxing pre-1913 income, which did not exist, obviously, in Civil War in 1894. And, I mean, even to the extent that capital gains were not clearly taxable at the time until 1920, the Supreme Court held they were, in the UK they were not. There was debate about this. And one of the problems was always this dividing line. So if you think about turning point for gifts, dividing line is that there's this constitutional question. that didn't exist or they didn't think existed before. I think that may have had some concern. You know, the idea of pre-appreciation property. What, you know, how do we distinguish those two? They were worried about it certainly with dividends. And other things. So maybe.
Yeah, that could be. That's a good suggestion. As to dividends, of course, they handled it by looking at corporate E&P accounts that would only begin as of 1913. And it's not impossible to imagine counterparts in the individual gift, but it's more complicated. There's not anything that's, because people don't, funds are fungible, and so you'd have trouble separating the pre-1913 assets from the post-1913 assets for gift purposes. At some point, that rule would kind of run out of steam, and they could have done something like what they did do temporarily with carryover basis in 1976, which is to pick a starting date and only look at a post appreciation after that date. But I'll try and find that article. Yeah, I'm sorry. Actually, there was Dennis was in front, and then Charlotte.
That's okay, Charlotte. Go ahead. Well, my point was just reinforcing Steve's and I hope my own papers that box 1 was unavailable under the same notion that you would be called to account to what a constitutional definition of income was. And the more you had the same value appearing over and over again, or the same value appearing not when it was income, but when it had already become capital, the more vulnerable you were to having
constitutional concerns. Yeah.
Real constitutional concerns, which would bog down the whole system. So it was easier to take the non-controversial route and get the thing up and running, rather than do things that would give the courts more chance to mess everything up.
Right. Okay, thank you. Dennis.
Yeah, 2 small points. The first one might help with the bridge the gap, the 25-year gap between the Revenue Act and publication of Simon's it's really a Chance Haig Simon's definition. I think there's a German economist named George Chance. And Simons himself sort of attributes the basic concept to this person. So you might want to look there.
Right.
The other, though, is maybe not, it's maybe, I didn't get to the part where you were actually talking about cases in real detail, so I'm not sure what you do with the dissents, in particular the Douglas dissent. If only because there's that great little book by Bernie Wolfman, students, which doesn't come out and say it exactly, but hints around the fact that with Douglas dissents after a certain period of time, maybe almost sold by the audit of his wife.
Right.
So,
after that, the taxpayer always wins. Right. So instead of counting 27 votes, I should only count 24, and then the IRS wins by a narrow margin instead of losing by a narrow margin.
Well, I don't want to ruin your paper.
It's okay. It's okay. Yeah, that's true. Douglas does, in many of his dissents after that point, he just says, "I respectfully dissent," or sometimes leaves out respectfully, right? But in Duberstein and Stanton, Duberstein, because Stanton came out the right way for him, but in the Duberstein opinion, he did write, for him, a pretty full and substantive opinion that begins with something like, "My view of gifts seems to be rather different than that of my colleagues," which was an understatement. But he does elaborate an explanation of why practically any voluntary transfer should be treated as a gift and excluded under 102. Okay, so we reached the time, and nobody seems to be urgently elbowing their way in. So great. Okay.